Welcome everybody to another eye opener. This is Market Wealth Daily's quick little video chats we do with top traders. And we've got Blane Markham back with us. Blane, so great to have you back, man. Looking good. Uh, Looking like you're doing great. Very excited to chat with you. A big shift in the market this morning. We came out of the gate down, and now it's maybe it'll recover again. Want to pick your brain on that. I know that you watch the stuff really close, but just great to have you back, and excited to have you here, man.
Absolutely. Yeah, no, it's been a little bit since I've been able to hop on. Yeah, as you know, I've been a little busy welcoming a new member to the family here in our household. It's been exciting times. So that's been great. Been enjoying some time with the family and having a little time off, but really excited to be back here for today's eye opener.
Yeah, congratulations. Congratulations, you and Elaine. Very excited for you guys. Just what a treat. So man, just to be a part of that's got to be incredible, but also exhausting. So again, thank you so much for being here, buddy. Um, folks, let me just remind you quickly. This is live. We like to hear what you have to say. If you have any questions or any thoughts as we're going along, go ahead and pop them in the chat box there. We'll try to address them all. Love having a live audience. It keeps us kind of in touch with what's going on for everybody out there. That's who we're trying to help out. So, Blaine, what are you looking at this morning in the markets? I'm really
Yeah,
interested
absolutely.
to get your take.
Yeah, since I been away for about a week since I was on one of these last, obviously a lot's been happening. Big bullish expansion over the market or in the market over the past week. So wasn't really able to touch on that too much either on Monday or last Wednesday since I just wasn't here. So just wanted to point out a couple things I've just been kind of watching from the background on. Let me go ahead and take over my screen share here, just so
Yep.
everybody can see what I wanted to chat about here. But yeah, so as we all experienced last week, the market was up. This is looking at a chart of the S&P 500 right here. We were sitting right at a pretty firm resistance level. The market was kind of banging its head on that ceiling heading into this past week. And then, of course, we got the giant tape bomb over the weekend that contrary to the market's expectations, there were significant updates in those meetings with between U.S. and Chinese trade officials, where there's going to be a pause in all of the very, very excessive, just incredibly high levels of tariffs between the two countries, and pausing them for 90 days. That led to just a massive jump higher in the market, which you can see right here. We had a huge gap up on Monday, and all of the subsequent days last week, every single day, the market continued to climb higher and inch higher after that massive leg up, just because of the massive relief to investors seeing a lot of those tariffs taken off one of our most important trading partners around the world. So really great news last week. But with that, of course, just looking back to the April lows, looking back to April 7th, where we hit the intraday low down near 48.50. Since that point, the S&P 500, as of Friday of last week, had rallied, I believe, nearly 23% from intraday peak to the closing price on Friday. So quite a substantial move that we've experienced in just about a month's time. A little over a month's time from that April 7th low to Friday's close of this past week. So just a rip-roaring rally higher, or a true V-shaped recovery, completely blown past all of the pre-tariff levels. This was the day all the tariffs were announced. Right here was this bar right here. So we've completely blown past that level. And as things stand right now, the markets that there's not a lot resistance level wise between where the S&P 500 index is trading right now and the previous all-time high that was set back in mid-February, just a couple months ago. There's kind of an air pocket in between there. We're largely through earnings season now. It was much better than feared. There was a lot of people really concerned about guidance and, was there any effect late in Q1 that was going to, make a hit on earnings? We didn't really see a lot of that. There was certainly some cloudiness on guidance, but all in all, earnings season came out very well. And so with that out of the way, we've gotten a lot of recent economic data that has been better than people have feared. So, a lot of these different really key points that move markets have started coming in and not being as bad as investors and different people around financial markets have feared. So that combined with the significant updates we've gotten on the trade front, that's led to this massive expansion higher in stocks and seeing this really strong recovery that we've seen over the past couple of weeks. So all that said, looking just in this stretch right here, I think there was a stretch where out of about 15 out of 17 trading days, the S&P 500 was higher, of course, culminating in last week's move where we just had just a massive jump higher, as I was touching on earlier. But with all that said, you can see pretty clearly that we broke through some very key resistance levels, that being the 200-day moving average, which is going to be our pink line right here. That was a very clear line in the sand that was above markets. That was going to be a very crucial thing should we be able to break through it. So as you can see here, we've broken through that, and now not only have we broken through it, we've closed above it for about 8 trading days in a row. So we've had very consistent follow through, which is a great sign. It's another sign showing that this move is legit. It's real. It really has legs. It has some staying power. Unless there would be some large negative development, like talks with China fall apart or something like that. Of course, hoping that doesn't happen. But should we continue to get good progress, the market's sniffing out that things are moving in the right direction. And you can see that we've broken through a number of key resistance levels. And with that, the market last week found itself in fairly overbought territory. So, John, you probably saw in my Periscope, I was kind of laying a lot of these things out in that newsletter that,
Yeah.
while, saw some great action last week, the S&P 500 found itself pretty quickly in significantly overbought territory. At least in the short term, not to say that we're gonna, drop down 10% from here. It's crazy overbought, but just it had jumped so high in just about 5 trading days that it really was due for some time to cool off. And I had kind of laid that out in my Periscope that after last week's move higher was great to see. Obviously thrilled for anybody out there that's invested in the markets. But I was fully anticipating that this week we would likely see a bit of a pullback just because of how far that rubber band had gotten stretched last week. So, that's shown on this chart right here. You can see our Keltner channels are overlaid. The index essentially closed above the upper Keltner channel band for 6 straight days. And that's also, you're seeing confirmation of that down here on this 5-day RSI chart. You can see that on a handful of days last week, actually on Monday as well, the 5-day RSI for the S&P 500 index was actually closing above the level of 90, which you can actually look back for the whole year. You can see that very rarely ever happens. That does not happen very often. And when it occurs, that's a pretty clear sign that stocks are about to cool off in the next couple days to next week. Just because they've run really far very quickly and are due for a bit of profit taking, just to let stocks just take a breath, just cool down. They're running red hot. Just as you would expect. This is just normal market forces, normal market behavior. But you're seeing that shown here on the chart. So we were fully anticipating that was going to happen. What's that, John?
Yeah, I was just going to say, so it's interesting when you look back at this kind of bungee jump that the market's done since since February or whatever, it had to come back up, but it's going to hit a point where, it's going to start to kind of, align itself, kind of get a little bit more calibrated. One of the things that's been very different about this market, and you pointed it out in what you were just explaining, is there's been a lot of events that were threatening to be pessimistic for the market. I'm looking back. The tariffs in and of themselves were very threatening. Some of the potential of bad economic data coming out. And things happened that you would think, oh, that's going to just kill this. And then as the market started to recover, more stuff was coming out, and you're thinking, oh man, that's going to stop it, but it didn't stop it. So you see this thing where some of the headlines are just not having the impact that they typically would. And as humans, we look at that stuff, big, mass crowd kind of information like headlines, and we think that should be very specifically correlated to the market, and it can it can get uncorrelated, which I think has happened a lot this year. And this is why. This is why your point at the end here, talking about looking at the data, looking at the chart, looking at the indicators, it's objective, right? So,
Hmm.
the threat that this thing has rallied and just taken off, um, and it's blown past things that everybody, oh man, it's a 200-day moving average, never going to make it past that. We're never going to make, bam, gone, right past it, right, blow through it, right? So, there's things that could have been threats that haven't materialized to be threats before. Now we have to really watch this and look at these things and realize that those these indicators are really powerful. They take all the news headlines, all the noise right out of the equation, and
Exactly.
then you can be unemotional and you can just trade based on the chart. And it's gonna, I think it's gonna show you. This thing has got to kind of, it doesn't mean that it's got to drop. That's why the Keltner channels are amazing. Like it just got to get back into the safe zone, so just watch it. And the big thing is, as you mentioned in your Periscope newsletters, just be alert to this as you're setting up trades, as you're looking at current trades you have in play. Keep this in mind because you might want to be a little bit more conservative to the long side. You might want to look for some emerging bearish opportunities that you can take advantage of. This broad market overlook is so valuable because it kind of sets the mindset, gives you the mindset that's going to make you more successful in each individual trade. So yeah, this is incredible, Blaine.
Absolutely. Well, thanks, John. And yeah, just to touch on what you were saying there, that's the beauty of technical analysis. It really is a great tool to have in your tool bag because it helps to solve the problem of, one of the most commonly faced problem by investors or traders out there is trying to avoid making emotional decisions with your trading, following all these headlines and seeing, oh, what if the jobs report comes in a little softer than expected tomorrow? Like, what is that going to mean for my portfolio? It's like, you can still, I'm not saying to ignore all that because, of course, if you're running a race, you need to be looking at the road ahead of you and seeing, when there's a pothole, you need to see what's coming, you need to see what's coming ahead, but you also need to look at data and make decisions based off of sound, objective facts and data. And that's what technical analysis helps you do. So that's why it's really important, as you're touching on, to look at these charts, not to just read, the headlines from whatever your preferred source of financial media is. It's best to hop into the data, analyze this stuff, see what is actually happening on the ground, and then go from there.
Yeah, and also to survey all of those sources. So we are a source. We are one source. I like to think we're the best looking source that's out there, but are we always accurate? Nah, not always. But what we're doing is we're providing context. So survey those sources, then make up your own mind. But make sure you have sources, and over time you'll find the ones that you connect with. It's so much less. I mean, there's definitely extremes where people are either completely wrong or they're amazingly right at a high level. But a lot of times it's what that information makes you think about, not what I'm thinking about, but it makes what you think more relevant, more accurate. So, kind of immerse yourself in that information. And we're just one of the places that you can get that, and I'm just grateful for folks like you, Blaine, taking the time to help us out with it.
Absolutely. Well, glad to be here. Glad to be here to help out with that and walk everybody through things that I'm personally seeing and just how I'm assessing the markets as they currently stand. But just to kind of continue touching on what I was talking about there, John. This move that we've seen off of the April 7th lows, as I mentioned, we've seen a peak to a trough to peak rally of a little over 23% based on the closing prices of this past Friday. So that's a massive move higher. That's a year's worth of gain on S&P 500 in a really good year. So I mean, that is it's a rocket ship higher in about a month's time. So with all that said, what does that mean? Well, as I was just touching on stocks, as we have touched on, the technicals were saying they were very overbought, at least in the short term. So we're fully anticipating stocks will just pull back just a little bit. Not saying they're gonna, just fall out of the sky from here, but we're expecting them to pull back, get a little closer back, back to the median, get a little closer back to the middle channel, cool off. But that doesn't mean that this recent move was a fluke. As I was saying, this move off of the lows is very meaningful. It certainly has all the signs of a very solid recovery that has legs and has room to continue moving higher. Should we continue to have positive developments? As I said, we've had confirmation of the 200-day moving average crossover. We've traded above it for what looks, based on today's range, what looks to be 8 trading days in a row. That's really solid confirmation. That level's now going to reverse from what was previously a level of resistance. It's now going to turn into a key level of support. So, you could see, just looking at our chart here, John, looking at that pink line, it is actually starting to slope back up now because of the recent movement. So that's a great sign. Love to see all of those moving averages on this chart starting to slope up, because that could be additional nice technical indicators down the road. But we'll cross that bridge when we get there. But talking about the 200-day moving average becoming now a level of support, you can see that's coming roughly in line where our middle Keltner channel line is. So, it could be very likely that, in the next week or so, we could be in for a retest of that 200-day moving average. So certainly would like to see that support level hold. That would be really key if we trade down to there and test that level, which it's certainly very possible, given the massive move that we've had just over the last couple of weeks. So that's just something to be watching out for. But all that said, I think that this recent move off the lows is very durable. I think I certainly don't think it's a fluke. I think this is very legitimate move, albeit, a little bit extended in the short term. We had very solid volume. That's what these bars are down here, John. It's just looking at the volume across the S&P 500. This was not a low volume rally like a traditional bull trap in a bear market. There was solid volume throughout this whole rally, particularly last week. So that was a great sign. One further thing I want to touch on here before I move into kind of a trade idea for today, I want to touch on this right here. This is the NIAD. And what this is the New York Stock Exchange Advanced Decline Index. So if anybody watching that's unfamiliar with this, what this is looking at is that all of the issues across the New York Stock Exchange on a daily basis. It's looking at all that volume trading on the exchange and how many shares are advancing versus declining, so rising or falling. And so what you really like to see in a bull market is you like to see this line going up and to the right, because that means more shares that are being traded across the New York Stock Exchange are rising compared to falling. So that's a very good indication of bullish momentum, broad thrust across the market. So that's something you really like to see. And you can see we've had that very clearly off of those April 7th lows. We've had a massive move higher. And actually just last week, this NIAD index actually began to set new all-time highs. So you can see we kind of stalled out, actually. We lost a lot of momentum starting in about October of last year. You can see momentum really started to fall off. It's just really stuck in this range-bound trading sideways. And the last high that we had hit on this was actually in late November. So as you remember, markets kind of sold off throughout December as well. We had a bit of a sell-off into the end of the year. So, we really lost a lot of momentum, but that started to regain now. So this is a very crucial thing to see here. Not only, we did make a new lower low here, but from that, we have rallied very strongly higher in this index. And now, just in the past couple of weeks, set a handful of new all-time highs on this. This is another just fantastic confirmation of the durability of this move off of the lows. So I would be certainly inclined to believe that this move off the lows is durable and it has the power to last. Obviously, different things can happen in the future to alter the course of stocks, but as things currently stand, John, this is really strong confirmation of the move off the lows.
Awesome. Yeah, that's really, really helpful. And again, a great kind of trading rule is to confirm with multiple indicators. There's no one indicator that's absolutely right, but when you see indicators start to line up, it really kind of gives you a lot more confidence, allows you to pull the trigger quicker and make sure that you're, able to get in quickly on the great trade. So thanks for sharing this, Blaine.
Absolutely. Yeah, no, it's always key. We never like to try and make, a final trading decision based off of just one thing. We definitely like to consult a number of different resources. So that's exactly right. What I was doing right here, seeing, a different indicator, trying to find confirmation of what I'm seeing in the other. And we're seeing that confirmation in a lot of different places right now, a lot of different market internals, a lot of different technicals. So there's a lot of very, very bullish signs for stocks, broadly speaking, right now. But all that said, I want to go ahead and hop into the final thing I was going to talk about. And there's a couple steps to this, so just bear with me. But as I kind of mentioned earlier, this has been very supportive for stock prices, that a lot of the recent economic data has begun, it started coming in better than feared, better than some, people's worst case scenarios. They were, very fearful about inflation reports and jobs reports and things like that. So, as those reports have started coming in, some of the more recent data points, albeit a lot of the tariffs that have been put in place, you're going to start seeing those in some of the upcoming reports. But given that some of the more recent data points that have come out, they've been a lot better than people were, fearing that they could be. So that's actually started to put some upward pressure on U.S. Treasury yields. And this is important because obviously there's competition for investing dollars, right? We all know this. So, people that are running massive portfolios, they're trying to figure out where they're going to allocate funds, whether it's going to be stocks, bonds, whether that be international stocks, international bonds. But as we know, there's a large bias towards U.S. stocks and the U.S. bond market. So, when U.S. Treasuries, you start seeing those yields start falling really quickly, in times of fear. That's because people are piling into piling into treasury bonds because they're doing the flight to safety trade, right? So we've actually seen a bit of the opposite recently. The stock market has started rallying higher. Animal spirits have returned, having the rip-roaring rally. So, you're seeing people come back into the market. There's also been a lot of short covering. So that's tying up a lot of competition for investing dollars out there. So between that and also having a lot of the U.S. Related macro data coming in better than expected, that's starting to see and put upward pressure, as I was saying earlier, kind of across the U.S. bond market. But I'm focusing right here. This is actually a chart specifically of the U.S., the 10-year U.S. Treasury yield. So this is not the bond price, but this is the bond yield. And we're looking at the yield because this is something that anybody investing in the stock market should certainly follow, because there's a high correlation between how this trades and how stocks trade. When we start seeing yields start creeping up, particularly the 10-year, this usually and not all the time, not 100% of the time, but a lot of times, this starts moving inversely to stocks. So the reason is this is a major input regarding borrowing costs and cost of credit for whether it's businesses or consumers, is where this 10-year yield is trading. And so I pull this up because, as you can see, it fell, it was bottoming out oddly with stocks at the same time in early April, but it's also recovered alongside of it. And, it's been much more muted regarding its recovery. But you can see now that this 10-year U.S. Treasury yield in the past couple of days has popped above 4.5% on a handful of occasions, and looks like it is beginning to trade higher and kind of break out of this range that it's been stuck in, and possibly start trading up higher, closer towards 5%. And again, that's based on better than expected macro data. There's a lot of talks going on in DC regarding the U.S. Budget that they're trying to pass, and what that's going to do to the U.S. government's deficit. If you see a larger deficit, that's also going to put upward pressure on U.S. Treasury yields as well. So all that is kind of working to drive this yield higher. So this is important, one, for stocks, but also, as I mentioned earlier, for borrowing costs. So what that is doing is driving up the cost of credit for consumers, for businesses. And what we're looking at right here, John, this is actually a chart of the average 30-year fixed rate mortgage across the U.S. So this is not actually updated on a daily daily occurrence. So this, I think, was actually updated last week. But you can see that the 30-year fixed mortgage rate is starting to rise now. We're starting to see, it had a bit of a out, but it's now starting to trend higher again. And if you actually look at the actual up-to-date daily price, you can find that online plenty of places. Where it's actually been trading the last handful of days is actually a touch above 7%. So this has rallied a lot higher. So if you're looking at an up-to-date daily chart, it would actually be trading right up in this neighborhood, challenging that about 6 months high that it made back in January. So the average 30-year fixed mortgage rate across the U.S. has actually now jumped back up above 7%. And there's a lot of hesitation for whether people are looking to refinance or buy homes. Especially if you're looking to build a home. When mortgage rates climb up over 7%, we've seen the past couple of years, that's really been a point where consumers are just saying, no, I'm going to wait. I'm not going and taking a mortgage out at 7%. So we're seeing that right here, and mortgage rates starting to rocket higher because of the move in treasury yields. Well,
Mhm.
this is all important because this is going to now tie into the trade idea that I was going to talk about for today. So what we're looking at here, and I think you'll understand why these two connect. This is a chart of Lennar Corp, and this is one of the handful of major home builders based here in the U.S. This is a massive home building company that's publicly traded on the stock exchanges, and as you can see, Lennar shares, they are in a very strong bearish trend. You can see they have had quite a tough ride over the past year, making numerous new 52-week lows really over the past 6 months. You can see that when we did have a quick bit of reprieve in rates, in April, the stock got a bit of a lift right here, but now that rates are starting to creep back up yet again, this stock is in a very, very clear bearish downtrend. And it's not currently oversold in the short term. According to our technicals, we can see, stocks trading well within our Kelton channel bands here. It's near the middle channel. Our RSI is not below 30. It's actually right about just a touch below 40. So that means that it has very weak relative strength, but it's not currently oversold. So this, because of what's happening in the mortgage rate market and the U.S. Treasury market, and combining that with just trends in home building right now, and also the trend of the stock, John, that's setting up for a really strong bearish trade selection for Lennar.
Yeah, it definitely looks like it. That, man, a lot to unpack there. Really grateful for you walking us through kind of the 30,000-foot view all the way down to the actual trade, looking at the broader context. It's something that you got to do sometimes, because that's where you're going to, if you look at the big picture, sometimes you see things you don't with your nose to the grindstone. So this is great. And one would think that, oh, you got the whole market going up, I want to be bullish. There are exceptions to that, and sometimes those are the big performers. Those are where the big opportunities are.
Right, exactly. And so, we doing a little bit of homework here, as I said, just I asked everybody to bear with me because I knew there was a couple steps to get to this trade. It's not just the technicals for this stock as to why it looks like a good setup. The technicals look, pretty solid here. The very clear bearish trend that's formed here, but there's some supporting technicals that I wanted to get through and kind of explain the methodology of how I thought about this trade. And anticipating that while we do have a very durable move higher, seemingly broadly in stocks, we are anticipating just for the next week or so seeing excuse me, some weakness, just because broadly stocks have gotten overbought. So that could help play into some early success potentially for this trade idea. But with all that said, so we're looking to probably look and go ahead and buy a put option to benefit should this stock for Lennar here continue to trade further to the downside. So what I've gone ahead and done is just pulled up an options chain here for Lennar. So you can see here for ticker LEN, I've gone and just pulled up the June 20th options chain and looking at the put options, of course. And the one I settled on right here was actually the 120 strike put. That's the one that I found just before I hopped on the call. And so I took that trade and just at the current prices. So this is, of course, option stock prices, they fluctuate pretty pretty quickly, but this was as of about 20 minutes ago, right before we hopped on. So you can see I've put this into our put option purchase calculator here just to just pull up the profit potential analysis of just what this trade would look like should I go ahead and take it. So you can see here's our stock symbol, current stock price. There's that 120 strike put we were looking at, and that was the premium that was trading at. That was the current market price as like I said, about 20, 25 minutes ago. And looking at this here, you can see this put option, it meets Chuck's 1% rule that we like to follow for a lot of our directional options trading here. As you can see, if the stock were to decline by 1% at option expiration, you see you have a positive return on the trade. So that means it meets that 1% rule. And looking a little further down this progression in this chart here, you can see, if Lennar were to sell off between now and June 20th, say if they're down 5%, between now and then, this trade would be able to profit 35.3%, off of that move. And then should, they really fall from here, say mortgage rates continue to spike higher, say Lennar falls off 10% between now and, that's where it's trading at on June 20th. This trade would be set up to produce a near 80% return. So, this is, definitely an attractive looking trade opportunity. As I mentioned earlier, we've had a massive move higher. We do expect stocks to cool off just in the short term, while, expecting a longer term durable move higher. In the short term, expecting things to cool off. And some of the other supporting factors for this trade. This does look like a very interesting setup in the market, given all those conditions.
Yeah, now this is a great one. Glad you ran it through the calculator there. I know those are some really powerful tools that you guys make available. And that also helps just kind of give you, again, that reassurance that, hey, I'm looking at this, how do I double check it? And that really pays out. I know that the strategies that Chuck has developed, that you've been a big part of, have just been game changers for so many people. I think I got a message internally, that there's going to be an event next week. Is that right? And did I catch that right?
There is, yeah. So we're pretty excited. We're hosting another live webinar. So it's going to be Chuck, myself, and then one of our other partners, Michael. They're all going to be live on a webinar. And so, folks, if you enjoyed how I walked you through that trade right there, some of the methodology behind it, love the technical analysis. Well, I highly encourage you to go ahead and attend the webinar we're hosting this coming Wednesday. So it's not, of course, not today, not this week, Wednesday, but next week. On the 28th, we're going to be hosting a live webinar, probably going to sit down for an hour or so, all of us, and we're going to be talking about a whole suite of all of our technical analysis and strategies, different approaches to the market. And so if you want to be able to get your hands on more, trades and more analysis just like this, then I would highly encourage you to go ahead and attend that live presentation. It's going to be really exciting. It's going to be a great time. So I would love to see you there. So John, I think you have a link you're going to post in the chat where folks can go ahead and register to attend that.
Yep, I did. I just dropped that in there for everybody, and we'll put it in the email when we send the replay out. So if you're watching
Fantastic.
this on the replay, you should be able to get into that. The thing that's amazing about these types of presentations is that they are live, and it's also the the interchange. And I think this is, if you're watching this and you're not really sure how this all goes together, uh, Blaine has been working with Chuck for a while now, and he's definitely one of Chuck's proteges. And being able to be in the room, the two of them are together, is just an exceptional opportunity. You get both of their insight, but you also see how you can learn. You're watching somebody who's learning from somebody who knows a lot, and it helps you be a better learner. So really encourage everybody to take advantage of this event. Great event, and I know there's going to be some great stuff that you're sharing in there, and some great opportunities. As always with these events, there's exclusive, benefits to it, discounts and things like that. So go and check it out. On the link, you'll get a little bit of a deeper dive into what's going to be covered there. So check out the link that we're posting and take a look. And hope everybody will be there. We're really looking forward to it. I'm glad that I got the heads up on that, because I definitely wanted to share it with all the folks watching these videos. This is great. So hey, Blaine,
Absolutely.
uh, thanks so much for taking the time. I know you got the new baby. You're still working your butt off like crazy. And I mean, geez, you got another presentation coming up next week.
Yeah,
I got my fingers crossed that you got a little bit of time to relax this weekend on the holiday. And Monday's a down day for the market. So I'm begging that you get to sit still for just a minute, man, and enjoy the life.
Oh yeah, no, you and me both. Yeah, I'm definitely looking forward to the upcoming holiday, and maybe I can find a hot dog or something to sit back and relax this coming
Yeah,
weekend, enjoy a cookout or something. So, no, I
yeah.
appreciate you having me back here, John. You know, always love getting to sit down and do these eye openers with you, and glad to be back here. So, looking forward to the ones upcoming this next week, and should be a great time. But for everybody watching, thanks for having me. I hope you all have a great week, and let John, I'll let you go ahead and sign off.
Yeah, well, thanks again, everybody. Keep your eye open for our eye openers, and we'll send the schedule out to everybody so you can jump in on these. And we would love to have all the questions, any stuff that you guys want to share with us. We love to hear about it. So take care and have a great holiday weekend, everyone. Thanks, Blaine.
Yep. Thanks so much, John. Take care, everybody.